Whole life insurance is one of the few money products that can sound safe, responsible, permanent, and protective, while still confusing the person buying it. The danger is not always in the headline. It is buried in the contract. Today, we are not attacking insurance. We are auditing the part most people skip after the sales pitch ends. If you are a U.S. middle-class professional trying to protect your family, manage a mortgage, or reduce financial anxiety, this audit is for you. We will examine why whole life can become a money trap, the hidden flexibility trade-off, and the difference between liquid savings and contractual value. Whole life insurance feels normal because it sounds permanent. It promises protection that does not expire as long as you keep paying. It builds cash value. For many people, that feels more responsible than term insurance. The appeal often appears during vulnerable moments. A new child, a new mortgage, aging parents. During those periods, people crave certainty. A product that combines protection with savings can feel like the ultimate security blanket. It presents itself as forced savings and responsible planning. But a product can feel responsible and still become a burden when purchased for the wrong reason. The problem is not protection. The problem is confusion sold as certainty. Every financial decision comes down to one question: what job is this dollar doing? Savings provide liquidity. Retirement investments provide growth. Term insurance transfers risk. Whole life attempts to combine all those jobs into one contract. For certain wealthy households, that structure can serve a purpose. For average households, one product performing multiple jobs often creates confusion. Buyers stop evaluating each function separately. The insurance cost disappears into the package. The growth component becomes harder to judge. The trade-offs become invisible. When one product has too many jobs, people stop analyzing each job independently. That is the trap. The package feels safe because everything is bundled together, but bundling can hide trade-offs. Before calling something safe, ask what happens when flexibility becomes necessary. If household needs change, those dollars are tied to the terms of a large legal contract. Clarity beats comfort every time. If you cannot separate the cost of protection from the benefit of accumulation, you do not own a financial strategy. You own a black box. Insurance transfers risk. Investing grows money. Savings provide access and flexibility. Contracts create obligations. Whole life attempts to fuse these separate operations together. Think of it like a Swiss Army knife. It can perform many functions, but it is rarely the best tool for a specialized task. Complexity creates structural costs. Those costs help fund administration, operations, and commissions. For some estate planning situations, the complexity may be justified. For most households, separating insurance and investing creates a cleaner understanding of net worth and financial control. When protection and growth are separated, you know exactly what you pay for insurance and exactly what goes toward investing. You retain control over both functions. That control becomes valuable when life gets messy. Flexibility often matters more than elegance. A product that looked clean on paper may feel restrictive during a job loss, family emergency, or major life transition. Financial systems should survive real-world stress. The cleaner the structure, the easier it is to adapt. The phrase cash value sounds reassuring. It makes people think of a savings account or money market fund. But cash value is not the same as cash. During the early years of many policies, a significant portion of premiums may go toward commissions, administrative expenses, fees, and insurance costs. As a result, cash value often builds slowly at first. The policyholder may contribute substantial premiums while seeing far less available value than expected. That difference surprises many buyers. Imagine committing to a meaningful monthly premium. If you cancel during the early years, the surrender value may be far lower than the total amount you paid into the policy. If you need money for a medical bill, home repair, job loss, or emergency expense, those funds may not be easily available. Unlike a dedicated emergency fund, the money is tied to contractual rules. This is where expectations often collide with reality. Many people hear that they can access policy value whenever they need it. In practice, they often do so by borrowing against the policy. The insurance company provides a loan using policy value as collateral. Interest is charged. If unpaid, interest may accumulate. If balances become large enough, the policy can become unstable or lapse. If death occurs while a loan remains outstanding, the balance is usually deducted from the death benefit. The money is accessible, but not in the same way many buyers assume. This is why the word cash can be misleading. Cash value may exist, but it is not simple cash waiting in a checking account. There may be surrender charges if you decide the policy no longer fits your life. Real life changes constantly. Jobs change, families change, expenses appear unexpectedly. A product that feels safe during a sales presentation may feel very different when you need liquid money on an ordinary Tuesday afternoon. Money locked inside a complex contract cannot perform other urgent jobs. It cannot immediately reduce high-interest debt. It cannot strengthen an emergency fund. It cannot relieve checking account pressure. It cannot directly reduce recurring financial stress from debt payments, car loans, subscriptions, or expensive habits. Cash value may have a role inside a policy, but it should not automatically be treated as a complete safety net. Opportunity cost deserves attention. The premium is not simply another monthly bill. It is a long-term contractual commitment. When people buy the policy, they usually evaluate affordability using current income. But life is not permanent. Income can change. Inflation can rise. Childcare can become more expensive. Medical costs can appear unexpectedly. Student loans and debt obligations can pressure cash flow. A permanent product may collide with a temporary reality. Many people buy whole life to reduce anxiety. But a rigid premium can create the same anxiety it promised to solve. The premium does not care if your car breaks down. It does not care if property taxes rise. It does not care if income falls or a paycheck arrives late. Financial obligations continue regardless of circumstances. That is where the trapdoor appears. Term insurance is generally simpler. Coverage ends if payments stop. Whole life introduces accumulated value, policy mechanics, and additional layers of complexity. Missed payments may trigger confusing outcomes involving loans, accumulated value, or policy adjustments. A product intended to provide peace of mind can become another bill that feels dangerous to modify. Complexity creates uncertainty exactly when clarity is needed most. Imagine a household that purchases a meaningful whole life policy while both partners are employed. The payment feels manageable. Years later, one income disappears. Suddenly, the premium competes with groceries, childcare, rent, insurance, and debt payments. If emergency savings are weak, the policy stops feeling like a savings plan and starts feeling like a pressure point. Financial systems should absorb shocks rather than magnify them. Before committing to a permanent premium, audit your foundation. Review your emergency fund. Review credit card balances. Review car payments, subscriptions, deductibles, and actual monthly cash flow after bills. Then ask one question: can this payment survive a bad year? If the honest answer is no, the product may be arriving before the foundation is ready. People rarely buy whole life because they studied policy mechanics for hours. They buy because they feel responsible. They buy because they feel scared. They buy because someone made the decision feel urgent. Fear can make a complicated product feel necessary before it feels understood. This is not an attack on agents. It is an audit of emotional decision-making. Questions about death, family protection, aging, and future insurability are valid. They come from responsibility and love. But fear is not a financial plan. Fear is a signal to slow down and investigate. Using a complex contract to solve a temporary wave of anxiety can create a long-term obligation that generates new stress later. Emotional relief should never replace understanding. Separate the fear from the product. Write down the real protection problem. Maybe your family needs mortgage support, childcare funding, debt repayment, or income replacement if something happens to you. Once the problem is defined, compare tools: term insurance, emergency savings, disability coverage, debt reduction, estate documents, beneficiary updates. A product should win because it solves the problem clearly, not because it temporarily calms your nerves. Whole life is not automatically a scam. It can function as a specialized tool. Large estates may use permanent insurance for liquidity planning. High-income households may use it after maximizing other tax-advantaged options. Families supporting special needs dependents may have unique planning requirements. But notice the pattern. These situations usually begin with strong foundations, stable cash flow, and clear long-term objectives. Many households are still building emergency savings, reducing debt, or catching up on retirement contributions. In those situations, the product may be out of sequence. A shaky foundation should be repaired before adding complex obligations. First, establish emergency cash. Then, control expensive debt. Then, secure affordable protection. Then, build retirement savings. Specialized contracts belong later in the process. Before buying or continuing a whole life policy, ask 6 questions. Can you explain it clearly without sales language? Do you understand what happens if payments stop? Do you know when cash value exceeds total premiums paid? Have you compared the cost against term insurance plus separate savings? Does the policy reduce stress because you understand it, or because it avoids uncomfortable conversations? Would you still buy it without words like permanent, guaranteed, or tax advantaged? Many people try to solve a system problem with a single product. They hope one permanent policy will permanently handle insurance, savings, and protection. But financial safety cannot be packaged into one commercial contract. Safe decisions provide clarity. Safe decisions provide flexibility. Safe decisions continue working when life changes. A product becomes a trap when emotional comfort replaces understanding of structural costs. This week, audit one financial product you already pay for. Ask what job the money is performing right now, not what it promised, not what the salesperson said. Retrieve the actual contract or statement. Review cancellation terms, fees, surrender provisions, renewal rules, loan conditions, and pricing structures. Do not rely on memory. Read the real document and understand the obligations attached to your money. This year, align insurance decisions, savings decisions, and investing decisions with their actual jobs. If you need insurance, buy insurance with clarity. If you need savings, build savings with access. If you need investing, invest with a long-term plan. Stop expecting one confusing product to solve every financial problem. The goal is not to avoid complexity. The goal is to stop calling something safe simply because it was sold that way.